Well, good day. I'm Paul Holba, Vice President of Retail Distribution. Thank you for joining us today for Funds in the Spotlight on October the 21st, 2020. Welcome to our webinar. Emotions are running high as the U.S. presidential race on November 3rd enters its final sprint. American voters are divided about which candidate is best for the country, while investors around the world wonder what the outcome will mean to their portfolios. Plus, we're heading into fixed income season, and it can be hard to know where to find balance and resiliency in this prolonged low interest rate environment. Fortunately, we have several funds to spotlight for you today. I wanted to thank you for all of your continued support of Empire Life during the COVID-19 crisis, and we really hope that you and all of your loved ones are safe and healthy. Your continued safety and health, along with that of our clients, is top of mind for us here at Empire Life, which is why our segregated fund products are available for sale non-face-to-face in our Fast to Full investment application. Fast to Full investment app has integrated screen sharing and video conferencing to make the experience of meeting your clients virtually to complete a new application, their fund, into their account simple, fast, and easy. And with our new gift commission campaign, you can earn up to 15% more commission on Empire Life gift deposits. So stay tuned at the end of the webinar as I'll provide more details on how that works. Now for the important information. This presentation reflects the views of Empire Life as of the date published and is subject to change without notice. The information in this presentation is for general informational purposes only and should not be construed as providing legal, tax, or financial and professional advice. I'll now turn the meeting over to Ian.
Thanks, Paul, and thank you everyone for joining us. Today we're just on the agenda. I'm going to give an overall market overview and an update on the investment team. Albert No is going to talk about fixed income solutions in this low interest rate environment. Doug Cooper is going to give an overview of the Canadian market and an update on the Dividend Growth Fund. And Ashley Mosqueda is going to say a few words about the upcoming U.S. election. Next slide, please. Firstly, on the investment team, I'm really happy the way the team's working together. We have well over 200 years of experience in the team. We're very seasoned and we've seen many market cycles. I'm not going to get into investment process. Doug Cooper is going to touch on that briefly. However, as most of the people on the call are aware of our investment process. I am going to discuss investment culture. Investment culture is very important to me. We have a very strong investment culture. It's really how the team interacts, how they share ideas, how they agree to disagree, and the respect that each person has for others' opinions. A consistent process and a strong investment culture is really the recipe for what leads to good long-term results. From my over 30 years in the industry, I've only seen a handful of investment firms or even investment departments that have both a strong investment process and a strong investment culture at the same time, and I believe we have both. If we go to the next slide, which shows our global team. So on the global team, Ashley's on the call. Most of you have either met or seen Ashley present before. He's going to make a few comments about the U.S. election. I will note David Mann, who runs our international equities, joined us approximately a year ago. He's been a great addition to the team. A few of you have had the chance to at least hear him speak, as well as Harsh Narasimhani, who joined us about 9 months ago. Both excellent, very, very happy the way they've melded into the team. If we go to the next slide, just to talk about our multi-strategy portfolios. Dave Patterson's coming up to 1 year of running our multi-strategy portfolios. For those of you who don't know, the multi-strategy portfolios are a combination of active and passive funds. We have 6 different portfolios, and we're looking to add at least 2 new portfolios in the new year. So very, very happy the way our multi-strategy portfolios have started. And it's a whole new platform, as most of you are aware, for us here at Empire Life. If we go to the next slide on the fixed income team. So the fixed income team right now is 3 individuals. We're looking to add 2 more individuals. We had one retirement, so we're looking to hire one portfolio manager to support Albert on the corporate and high yield portfolios, as well as an investment analyst that will support the whole team. If we go to the next slide. So I'm going to say a few words just on the market and our strategy, and then I'll pass it to Albert. But it's been a strange year for everybody along a lot of measures. Equity markets no different. If we break out the year, we had January to March 23rd, where we had a significant drawdown in the market. We had March 23rd to October 2nd, which is when we did the slide, significant rebound to give us the return year to date on the right. I think if any of us had guessed March 23rd that the year to date performance would look like it does in some markets, I don't think many people would have bet on that. That picture on the right, in my mind, is 100% because of unprecedented government stimulus. It would look a lot different if we didn't have that. With almost zero rates and negative rates in some countries, government payments to individuals and companies to support them ongoing as we're in the pandemic, we've had that performance that we see there on the right. That result of easy money has been what I call a bifurcated market. So it reminds me a little bit of the year 2000. Now, there are obviously some differences, but some sectors have participated while other sectors have not participated at all. So if I look at the TSX as an example, year to date down 2.6%, and that's total return, including dividends and local currency. We've had one stock, Shopify, represent almost 4% of performance, and materials, which are mainly the gold stocks, represent close to 3%. So we have one stock and a small group of stocks represent 6.5 to 7 positive performance in the index, and an index is down 2.6. We've had certain sectors, financials, energy, and REITs, as an example, be significant drags on the index. There are very, very good companies within financial, energy, and REITs, which we do own some of, that have very good long-term prospects, but do have some short-term headwinds. If I look at the S&P 500, once again, a strange bifurcated market, positive 5.1% on the year, but we have 5 stocks that represent 23% of the index. That would be Apple, Microsoft, Amazon, Facebook, and Alphabet. Those 5 stocks represented positive 7% year-to-date performance. So once again, we have a number of sectors and companies that have been left behind. So our strategy within this, in a nutshell, is one, we've been taking a lot of profits in the names and the companies we bought in the January-March timeframe. Some of those companies are up between 50 and 100%. Number two, our focus really right now has been to find the high quality companies with good long-term tailwinds that are well managed, which have effectively been left behind in this market, that are trading at attractive valuations, whether price to earnings, price to cash flow, and below their intrinsic value. Those will represent good returns over the next 2 to 3 years. And thirdly, what's the solution for the economies opening up? In our mind, it's a combination of a vaccine and rapid testing, which will allow the economy to open up. When we get that, we don't know, obviously. But when we do, where will the pent-up demand be? What part of the economy and what companies will perform well over the next 2 to 3 years, because there's enormous pent-up demand. Those are the 3 factors in strategy that we're focusing on right now. At this point, I'll wrap it up. I'm going to pass it over to Albert to speak on the fixed income solutions.
Thanks, Ian. So, I always like to start with asking, what are investors trying to solve for with their fixed income allocation? And, this is an even more topical question with the low rate environment we find ourselves in. And remember, fixed income is critical in a balanced portfolio to meet a few objectives. One is to diversify and provide a hedge against your equity portfolio. The second is to preserve capital. And the third is to provide income to both preserve and grow your purchasing power over time. And as we all know, just given the impact of the virus, we find ourselves in this low rate environment. Today the yield on the U.S. 10-year Treasury is 70 basis points, which is very near to all-time lows. So how should investors think about their fixed income allocation in this rate environment? If you can flip to the next slide. The answer is the same as always, and that diversification is always critical in your fixed income portfolio to meet those objectives that I talked about. Unfortunately, there is no free lunch, especially in investing, and how you optimize that fixed income allocation is really dependent on the objectives that you prioritize, your return hurdle, your current risk exposures that you want to diversify from, and your overall risk tolerance. So this is just a snapshot of Empire Life's fixed income offering, which currently consists of 3 funds meant to meet the various objectives that I highlighted. When I joined about 3 years ago now, our only fixed income offering at the time was the bond GIF. And since then, we've launched short-term high income as well as strategic corporate bond. And in comparing and contrasting the 3 funds, starting with the bond GIF, of our offering, this fund is the best at hedging against overall equity exposure and has the lowest credit risk. And as I said earlier, there's no free lunch. So the trade-off here is that it has exposure to the highest amount of interest rate risk of the 3 funds, as well as the lowest yield of the 3 funds. On the other end of the spectrum, on the left-hand side, is short-term high income. And of the 3 funds, it offers the highest yield, as well as the lowest rate risk. But the trade-off here is that there is higher credit risk in the portfolio. And somewhere in the middle is strategic corporate bond. It offers a higher yield, close to short-term high income, and is somewhere in the middle of the 2 in terms of overall credit risk and interest rate risk. And again, I'd just like to remind everyone that the optimal mix here is really based on the objectives you prioritize, your return hurdle, your current risk exposures, and your overall risk tolerance for various forms of risk. The next slide, please. I'd like to dive a little deeper into the composition of our fixed income offering, with the focus on strategic corporate bond and short-term high income, which I manage. So in terms of asset class mix, these funds are diversified along 4 broad asset classes that provide different risk and return profiles. Broadly speaking, the categories are cash and government bonds, investment grade corps, high yield and converts, high yield and then converts and preferreds. Generally speaking, as you move down those boxes, there's an increase in credit risk as well as an increase in potential return. So the green and purple boxes, which are both investment grade rated, really try to accomplish the objective of preserving capital. And the light blue and dark blue boxes are typically not investment grade and provide extra yield and potential return. So as you can see from the charts, as we move from left to right, the funds take on additional exposure to high yield, converts, and prefs to provide additional yield and return potential. And broadly speaking, strategic corporate bond is, generally speaking, 2/3, 1/3 investment grade high yield, while short-term high income is the inverse, with 1/3 investment grade, 2/3 high yield, generally speaking. Next slide, please. And so despite this increased exposure to high yield, converts, and prefs for strategic corporate bond and short-term high income, the exposure is invested in a very prudent way. There's a focus on bottoms-up credit research, understanding the companies, understanding the credit risk associated with the companies, as well as assessing a risk versus reward trade-off. I'd like to highlight that strategic corporate bond and short-term high income are not the index. You can see the high yield index on the right. our strategic corporate bond and short-term high income funds have an up in quality bias with low exposure to the riskiest spectrum, just to manage the overall credit risk in the portfolios. As you can see on the left and middle bar charts, the strategic corporate bond and short-term high income have a very have a meaningful exposure to investment grade credit ratings, which are the dark blue and gray boxes, with 2/3 and 1/3 respectively. Obviously, the high yield index does not have any exposure to investment grade, and investment grade is typically higher credit quality and lower risk and overall lower volatility. At the bottom end of the risk spectrum, you can see the triple C or less in blue, which has the highest credit risk. It actually makes up more than 10% of the high yield index. It's at around 12% right now, whereas our funds have less than 2%. Again, the main takeaway here is that our funds have an overall up in quality bias and are not the index. Next slide, please. And finally, I just wanted to highlight the fund's performance during these recent bouts of market volatility that we've had. During periods of market volatility, investors should want out of their fixed income allocation to preserve capital relative to their equity exposure and relative to other credit indices and benchmarks. So the most recent periods of volatility we've experienced were in Q1 of this year and Q4 of 2018. So as you can see in the chart on the left-hand side, I think we all remember Q4 2018. The prevalent risk at the time was a Fed raising interest rates at a pace that the market thought was too rapid, and that caused a sell-off in that quarter. The bond gift did what it was supposed to do. It generated a positive return during this risk-off period, and preserved capital better than the S&P 500, investment grade corps, and high yield. And strategic corporate bond at the time was positioned more like a high yield fund, and it did its job by preserving capital relative to overall high yield. On the right-hand side, you can see during the volatility we experienced in Q1, the bond gift, strategic corporate bond, and short-term high income all preserved capital relative to the S&P 500, investment grade corps, and high yield. I will say that during Q1, the overall market, including investment grade corporates, experienced an extraordinary outcome of extreme drawdown. And you can see there the IG corps were down 14%. And that's what was largely a contributor to the bond gift having negative returns. But under more normal circumstances, the bond gift does preserve capital and does have a negative correlation to equities. It's just that Q1 was, as we all know, was a hopefully once in a lifetime occurrence. And that's it for me, and I'll pass it along.
Thanks, Albert. So a few things I want to touch on. If we just move to the next slide. First, a quick review of our investment style, an update on Canadian equities, as well as an update on the Empire Dividend Growth Fund, including some company examples. So on the next slide, many of you will be familiar with our investment style and process. So I'm not going to spend a lot of time here. Our philosophy is to invest in attractively valued, high-quality companies with a focus on capital preservation. And there are three important pillars of this philosophy. First, value. So not deep value, but instead investing in high-quality companies with conservative capital structures that trade at a discount to fair value. So how do we do it? We're bottom-up fundamental investors, spending a lot of time on understanding companies and the industries they operate in. Margin of safety is important, which we get through valuation and also avoiding companies with too much debt. We can be contrarian in nature as a result of our 3 to 5 year investment horizon. And then finally, conviction and independent thinking are also key tenets of our approach. Moving to the next slide, I want to highlight three important aspects of our investment process. First, we want to invest in companies that have a sustainable competitive advantage or moats, which allows for persistently high returns on invested capital, as well as attractive and visible growth prospects. We also want the management team to have a good track record of capital allocation and aligned incentives. And then finally, through a number of valuation approaches seen here, we spend a lot of time figuring out the fair value of a business, and then we'll only invest at a discount to this fair value. So starting with the next slide, I'm going to shift over to an update on Canadian equities, and Ian touched on this a little bit earlier, but year to date, as of September 30th, the S&P TSX was down only about 3%. But over this time period, there's been a massive dispersion of returns across sectors. So as can be seen here, technology outperformed substantially. And again, Ian mentioned this earlier. This is a result of Shopify, which I think as of yesterday was up about 175% year to date, and now makes up about 6.5% of the S&P TSX. And then materials also outperformed substantially, driven primarily by gold stocks, which make up a very big part of the TSX today. And then on the other end of the spectrum, sectors such as energy, real estate, financials, and communication services, have really underperformed. So moving on to the next slide, a major implication of this dispersion in sector returns has been a drastic outperformance of growth investing versus value investing over the year-to-date period, and not just in Canada, but also in the U.S. and internationally, as can be seen on this slide. And then shifting over to the next slide, another implication of this bifurcation in sector returns has been a significant underperformance of dividend payers versus the broader market. And again, not just in Canada, but also in the U.S. and internationally as well. So it's been a difficult environment year to date for value mandates and especially dividend mandates. I think one last point I'll make is that the year-to-date underperformance of these mandates is mostly the result of them lagging the sharp recovery in equities since the end of March, which has been mostly propelled by technology and gold stocks, at least here in Canada. So I'm going to shift over to the Empire Dividend Growth Fund to highlight a few points. So on the next slide, if you could switch over. I was appointed lead manager in June 2019, and since then, I've repositioned the fund away from cyclical, macro-sensitive stocks to defensive growth stocks, where there's more visibility on free cash flow growth through the cycle, to support dividend increases over time. So today, these companies make up the vast majority of the portfolio, which will remain the case going forward. So this is a structural change and not a tactical one. Third, while the fund is a Canadian dividend fund, about 60% of the fund's revenue is generated outside of Canada through global stocks, which today make up about 26% of the fund, and this can go as high as 30%. And also through Canadian domiciled companies that generate the majority of their revenue in the US and internationally. So the fund does provide a good balance between Canadian and global exposure. I'm also finding attractively valued high quality companies in Canada and globally, and I'm going to touch on this a little bit later on. And then lastly, the portfolio's dividend yield is roughly 3.5%. And this is supported primarily by companies that have very good visibility on growth and dividend increases over time. So I think in a low rate environment, these type of companies should eventually command a scarcity premium as investors climb the risk curve looking for higher yield. So the next slide shows the fund's top 15 names, which make up about 50% of the portfolio. Canadian banks are a significant part of the portfolio where I see a lot of value taking a longer term view. Today, the banks are trading at just over 1x price to book. Clearly, they face headwinds primarily from the effects of COVID, but capital levels are at record highs. The banks are very well provisioned, and dividends, which the big six banks have maintained through the COVID crisis, in my mind, appear very safe and on average are yielding about 5.5% today. So in an environment where COVID headwinds are behind us, and I do think we eventually get there, I see the potential for a material valuation expansion as growth recovers and banks restart dividend increases and buybacks. I'm also seeing a lot of value in Enbridge at less than 15 times earnings. Valuation is at an all-time low, and its dividend is yielding nearly 9%. This is a high-quality business with an extensive energy infrastructure footprint spanning across North America that really cannot be replicated. And then also the vast majority of its earnings is made up of long-term take-or-pay contracts. So it has attractive and visible growth prospects that isn't really tied to commodity prices, but more demand for oil and natural gas, which in my mind remains robust over the medium term. So coming back to my earlier comment that most of the fund's revenue is generated outside of Canada, the fund also owns Stella-Jones, which is North America's largest manufacturer of railway ties and utility poles. And while domiciled in Canada, Stella-Jones generates about 70% of its revenue in the US. The majority of its revenue is driven by replacement demand, so it's a utility-like business with attractive growth prospects. But the other last point I want to make is the fund currently owns about 14 global stocks, and you can see that 4 of them are in the top 15, including Philip Morris, UK-based Bunzl, Unilever, and Bureau Veritas. And these are all very high quality businesses with attractive and visible growth prospects, which we added to the portfolio at attractive valuations. So moving to the next slide, I just want to show the fund sector breakdown. So the fund is currently underweight technology and materials. Again, materials would be mostly gold stocks. And this is primarily because there are limited dividend paying companies in these sectors, but also because I'm just not finding value, in these sectors in Canadian technology, especially. As an example, Shopify is currently trading at about 40 times sales. However, on the technology side, the fund does own Alphabet, which I'm going to highlight a little bit later on. It also owns OpenText, which is another example of a very high quality Canadian company that is very global. It generates only about 5% of its revenue in Canada. And then the fund also owns 2 other US-based technology stocks, which will remain unnamed for now as I'm currently building up the positions. You can see the fund is overweight consumer. I'm seeing a lot of value in this space. Financials is slightly overweight, with Canadian banks making up the largest component. And then energy is more in line with a TSX, and this would be heavily skewed to pipelines like Enbridge and TC Energy. So moving to the next slide, I'm going to highlight 2 companies currently in the Dividend Growth Fund to illustrate the type of companies that I'm attracted to and also the disciplined approach to valuation. So the first example is Restaurant Brands International, or QSR, which has a very material competitive moat backed by its iconic brands, including Tim Hortons, Burger King, and Popeyes. QSR has a good management team with a proven track record. The recently appointed CEO, Jose Seal, ran Burger King since 2014, and he did an excellent job turning this brand around and growing it. Growth is attractive for the company. Pre-COVID, the business was growing organically in kind of the mid to high single digit range that I think it can eventually return to as we get through COVID. The company has a strong financial position supported by a significant amount of liquidity and its franchise model, which requires very little capital and also has a low operating leverage. Referring to the 3-year stock chart on the right, the green circles represent where we acquired QSR during the COVID-related sell-off in February and March, at an average of about 14.5 times earnings and an average dividend yield of around 5.5%, which in my mind was just very compelling, just considering the attributes of the business. And then finally, just the last point, QSR maintained its dividend through the COVID crisis, which I think is a real testament to the resiliency of the business and also its strong financial position. So moving to the next slide, the company I want to highlight is Alphabet, or Google. You know, Google, much like QSR, has a very wide competitive moat, and this is backed by dominant position in search advertising, which, coupled with its billions in R&D, allows the company to serve up superior search results for its users. Its competitive positioning is further reinforced by YouTube, which gives Alphabet a dominant position in video advertising, and other assets like Google Maps and Android, which is the dominant mobile operating system. The company also has a very good management team. The CEO, Sundar Pichai, ran Google since 2014, and then prior to that, he held a number of senior positions at Alphabet, where he built up an excellent track record. It also has attractive growth prospects, in kind of the mid to high teens range as ad dollars continue to migrate online. Its balance sheet is very strong, with over $100 billion in net cash, and that's about 10% of its market cap. And then in terms of valuation, I added Google to the portfolio in June of 2019, as shown by the green circles on the 3-year stock chart, where the stock was trading at about 17.5 times earnings, and if you exclude cash, about 15.5 times earnings. At the time, back in June of last year, the market was really concerned about antitrust headwinds and slower than expected top-line growth, I think in Q1 of 2019, which pushed valuation down to very compelling levels, just considering the attributes of its business. And then the last point is I sold some of my position in December of last year, as indicated by the red circle, and then actually added to my position again at the depths of the COVID-related sell-off in February and March, where valuation had come down to, again, a very attractive level, around 17 times earnings. And then more recently, I've actually been trimming my position as valuation has expanded quite a bit. So this is a good example of being very disciplined, not just on the buy side, but also on the sell side. So to sum up on the next slide, our team continues to be disciplined with our investment approach, taking advantage of what has been some very volatile equity markets year to date. This has allowed us to add some high quality companies at attractive valuations, and I'd say QSR and Google would be two examples of this. Lastly, I feel very good about how the Dividend Growth Fund is positioned today, consisting of attractively valued high quality companies in Canada and globally, with compelling and visible growth prospects. So with that, I'm going to turn it over to Ashley for some comments on the upcoming U.S. election.
That's great. Thank you very much, Doug. Let me start out by saying something that I think is really important, but often gets lost in the midst of the fever of an upcoming election. When all is said and done, the most important variables that are going to affect the long-term performance of the fund that I'm associated with is the performance of the businesses we buy and the price we pay for them. Policy can and will be headwinds or tailwinds, no question about that. But markets are going to move up and down both in Republican and Democratic administrations. The only thing I will say by way of prediction is to remind everyone that at this point in the last presidential election cycle, the prevailing wisdom in the market was that Hillary Clinton was going to be the next president and that she would be good for markets, whereas a President Trump in the unlikely scenario that that would happen would be terrible for markets. So given that that was the prevailing wisdom about 4 years ago, it seems wise to keep an open mind about possible outcomes. So the range of possible policy outcomes in this election is actually pretty broad. So maybe let me touch on that and some of the possible downstream effects. I'm not really contemplating a Republican pickup of the House, since polling is just too far away from that at this point. A Biden presidency with the Republicans holding the Senate would probably not be all that consequential. There would likely be a logjam with legislation, some difficulty for Biden to appoint judges and administration appointees, and most of what we'd likely see done would be done by executive action. If we end up with a status quo with a President Trump, Republican Senate, Democrat House, we may see some more aggressive foreign policy, specifically with respect to China. That's more within the domain of the executive. But I wouldn't expect huge deviations in there in the totality of what we've seen in the last couple of years. Now, a Democratic sweep would be the largest deviation from where we are today, and that appears to be becoming more likely if the polls are accurately predicting the composition of voters in the election. So that's where I'll focus a little bit. On the positive side, or negative, I guess, depending on the downstream consequences, I'd say there's a pretty good chance in that scenario of major fiscal stimulus, possibly in the multiple trillions of dollars. This would likely benefit industrials, materials, and energy to some extent, because it would be quite stimulative to the economy. We'd probably see benefit to businesses either directly or indirectly exposed to alternative energy. One wild card in this scenario is whether this amount of money chasing a limited amount of goods would cause inflation, and I think that's certainly something to keep an eye on. There would likely be some negatives to this scenario of a Democratic sweep. One of the things that most Democrats agree on is that they want to raise taxes. And when a party takes power, typically an easy place to start legislatively is something they all agree on, where they wouldn't have to do that tricky inter-party negotiation. Regardless of what that number happens to be of increased taxes, it would just mathematically reduce earnings on the S&P 500 and mathematically increase the already high multiple. And of course, this assumes all other things being equal. I would also expect more onerous regulation on banks, an attempt to throttle U.S. shale energy production, particularly in the form of fracking. Now, this could ironically be good for Canadian producers if the reduced supply of oil globally causes prices to rise. U.S. big tech companies could also be in the crosshairs. We recently saw a report from one of the subcommittees that's tasked with antitrust. And at first blush, this would appear negative, and it certainly would likely be for some companies. But it's not clear that shareholders wouldn't be better off if, in some cases, some of the companies were forced to separate parts of their business. The shareholders may even be better off in that scenario. So that's kind of a company-by-company thing. Finally, I'd expect more pressure on drug prices, and this could pressure pharma and biotech stocks. So that's a real handful to get done in its totality in 2 years, and more realistically in 1 year, since by the second year, of a 4-year presidential term, by the second year, members of Congress are up for re-election and are back in campaign mode. So we'll get some more. We would get some more insight in this scenario based on what the ranking on the priority list of legislative accomplishments would be. Often, though, other factors intrude, as highlighted many years ago in the famous response to a journalist by British Prime Minister Harold Macmillan. When he was asked about the greatest influence on his administration, he replied, "Events, dear boy, events. We have tension with China, North Korea, an assertive Russia, a Middle East that remains a potential source of conflict, and of course, a pandemic to deal with." Those all have the potential to upend things. And let's remember, it wasn't that long ago that everyone expected President Trump to be handily reelected on the back of a roaring economy. So we'll have to see what happens as we go forward from here. With that, I will turn it back over to Paul.
Great, thank you, Ashley, and thank you everyone for your thoughts and insights today. We do have a couple questions that have come in that we'll ask. And my first question is for Albert. So Ashley referred to fiscal spending and the potential associated inflationary concerns, which we hear quite a bit about. In an inflationary environment, how do you manage your fixed income portfolios?
Thanks, Paul. So first of all, just to speak to inflation briefly, currently markets pricing in that the 5-year inflation will be around 1.7%. So that's the sub 2% average that the Fed is targeting over the long term with their policy. Just in terms of managing portfolios in anticipation of inflation, I think inflation inherently is difficult to predict, and so our process really focuses on trying to just manage overall interest rate risk and overall duration in the portfolio. So when you think of short-term high income and strategic corporate bond, both those portfolios have relatively low duration. For short-term high income, it's around 2 years. For strategic corporate bond, it's in around 4. And that's really how those funds manage the exposure to inflation. So if we were to get an inflationary environment, what would happen would be, policy rates would, the Fed and central banks would then start to increase rates, and overall, you would expect overall interest rates to rise, which typically would be a significant headwind for portfolios with longer duration. So in the event that we do have higher inflation, higher rates, short-term high income in particular would be very well positioned against that, and as well so would strategic corporate bond.
Great. Thank you, Albert. Final question is to Doug. Doug, if there was one sector in Canada that you thought would perform well over the next 2 to 3 years, what would it be?
Thanks, Paul. It's a good question. I'd have to say that financials would be the most attractive sector, taking a 2 to 3 year view. And I already highlighted the Canadian banks as being very attractive, but I'm also seeing a lot of value in Manulife and Brookfield Asset Management. I think the first point is that all of these companies have sustainable competitive advantages, making it very difficult to disrupt them. And then equally as important, that strong competitive positioning that they have positions them very well for growth over the medium term. The second point is that valuation is very attractive. As I mentioned, the big 6 banks are trading at just over 1 times price to book. Manulife is actually trading well below book value, around 0.7 times. And then Brookfield Asset Management is trading at a sizable discount to its NAV. And I think the last point is that, these companies all face unique headwinds related to COVID. But I think the important point is that these headwinds are more than reflected in valuation. So we have a margin of safety through valuation. So taking a longer term view, once we get through COVID, which I'm very confident we will, over the next 2 to 3 years, the total return potential is pretty compelling, supported by 3 factors: an expansion in valuation, dividends, and then growth of the underlying businesses. And just to put some numbers behind this, if the valuation of the Canadian banks were to expand to 1.5 times or 1.6 times price to book over the next 3 years from about 1.2 times right now, and you couple this with a 5% dividend yield and a very conservative low single-digit growth assumption for the next 3 years, that would result in a high teens annualized total return over the next 3 years, which I think is very, very compelling. So I'd definitely say the financials is where I'm seeing most of the value, and that would actually make up a big chunk of the dividend growth fund, as I talked about earlier.
Excellent. Thanks, Doug. Yeah, certainly lots of value there. I would like to thank Ian, Albert, Doug, and Ashley for their insights, for joining us today, and thanks to all of you for participating as well. The investment team does continue to find investment opportunities in all market cycles. You can stay informed on the team's activities with our investments blog. We have our Emblem Portfolios asset allocation updates, our portfolio manager interviews, and our newsletter from the desk of Ian Hardacre. All of these you can find at our website at empire.ca. Now, if you do have any questions about today's webinar or about our industry-leading product choices, always please contact your Empire Life sales team. This webinar is going to be posted to our website shortly, We'll send an email out to all advisors so you can listen to it again at your leisure, or pass it along to a colleague who may have missed it today. I think you'll agree there's been a lot of really great information shared here. CE certifications will be mailed within 2 to 4 weeks. Before we go today, I just have a couple of more brief comments. First, we want to make sure that we're providing you with the tools that you can use to help to sell segregated funds. Now, unfortunately, like many other carriers, we've had death claims due to COVID-19. Now, this brochure illustrates a real-life situation and the value of segregated funds in volatile times. The client passed away this spring. Markets were down due to COVID. Fortunately for his family, he was invested in our 7,500 guaranteed investment funds, which provided him with the annual death benefit guarantee reset. So his previous years of market growth have been locked in, and his family received the full benefits, not the market value. Ask your Empire Life sales team for a copy of this client-friendly brochure, which has been very popular. And finally, to wrap things up, the details of our gift commission campaign, which I teased earlier and you've been waiting for. Now, this campaign runs from September the 1st to December 31st, 2020. We're paying 10% bonus on all gift deposits, paper or digital, payable every week with our regular commission payments. Plus, we're paying a one-time extra 5% bonus for all digital deposits, and that will be payable in early 2021. Again, please contact your Empire Life sales team for more information. Finally, I'd like to thank you all again for joining us today. Wish you all and your families safe, healthy fall, and this will conclude our webinar for today.